Welcome back to the Deep Dive. It is Friday, February 13th, 2026. Happy Friday the 13th to everyone listening. Today, we're doing something a little different.
A little bit.
Usually we take a company, we look at the numbers, we get excited about the growth engine, and we try to figure out, just how big the total addressable market is. We're always looking for reasons to say yes.
But today, yeah, given the date and given the specific company we are looking at, we are flipping the script. We are putting on our detective hats.
Yeah.
Or maybe our forensic accountant visors.
Exactly. We're applying a specific methodology today. We are calling it the skeptical buy-side framework.
Right. And for those who haven't spent time on a frantic trading desk or in a risk management committee, let's define what that actually means.
Please do.
The skeptical buy-side framework, it flips the burden of proof. So usually investors look for reasons to buy. They want to believe the story. Under this framework, the default answer is no. The company is considered uninvestable unless proven otherwise.
Guilty until proven innocent.
Precisely. We assume the bear case is true. We assume the accounting is aggressive. We assume the growth is slowing. And we force the data to prove us wrong. If the data can't fight its way out of that corner, we walk away.
And the subject of our interrogation today is a massive name in enterprise software, a company that has been a darling of Wall Street for, over a decade, ServiceNow, ticker symbol NOW.
Or just NOW. Yeah, it's a titan. But we aren't just reading the press release today. We're looking at a snapshot of ServiceNow as of today, February 2026. The market is eyeing their massive pivot into AI. They've expanded their footprint everywhere.
Right.
On the surface, if you just look at the stock chart and the headline revenue, this looks like a slam dunk.
It really does. I mean, looking at the valuation report we have in front of us, the stock is trading around $109.
Right.
But the fair value estimate, it's sitting at $200.
Right.
That implies significantly more than just a margin of safety. That's almost 50% upside.
And that is exactly where the trap is set. Because if you just look at that headline, undervalued, high-growth AI leader, you hit the buy button before you finish your coffee.
Sure.
But we have a problem today, a specific critical problem with our source material that triggered this skeptical framework in the first place.
Right. This is the underwriting failure we mentioned in the intro. So we have this detailed analyst report. It's from Morningstar, dated just a week or so ago.
Yeah.
It gives us the narrative, gives us the summary tables. But what is missing from our packet?
The prime issue source documents are missing. We do not have the 10K. We do not have the latest 10Q. We don't have the raw earnings call transcripts. And in our skeptical framework, that is a fatal flaw. It's a deal breaker.
Walk us through why that matters so much. I mean, if we have the analyst report summarizing the numbers, why do we need the raw 10K?
It's like trying to buy a house, and the realtor gives you a glossy brochure that says, great foundation, but refuses to let you go into the basement to, look at the cracks in the concrete. The analyst report tells you what the company wants you to focus on. The 10K tells you what they are legally required to disclose. The difference between those two things is often where you lose your money.
So the mission today is to see if we can trust this great story if we can't verify the raw data. Is this a great business trading at a discount, or is it just a good business masking a deterioration in quality?
Or worse, is it a business that is fundamentally changing its risk profile while everyone is still looking at the old metrics? Let's find out.
Okay, let's unpack this piece. First, we need to define what ServiceNow actually is in 2026, because I feel like a lot of people, even in tech, still have this mental image of them from, 10 or 15 years ago as the IT help desk guys.
That is the origin story. That was the wedge. Back in 2004, Fred Luddy founded the company on a simple premise. IT departments were a mess. They were using email, spreadsheets, sticky notes, phone calls to manage complex work.
A total black hole.
Yeah, if your laptop broke or you needed a password reset, you send an email into a black hole.
And maybe 3 days later, someone would reply.
Exactly. So he built a system to organize that chaos. It was IT service management, or ITSM, structured workflows for IT tasks.
The digital plumbing of the IT department?
Precisely. But they pulled off one of the most successful pivots, or really expansions in the history of software. They realized that submitting a request and routing it to the right person to get something fixed isn't just an IT problem.
No, it's a universal corporate problem.
It is.
Right? I mean, think about human resources. When you hire a new employee, What happens?
You need to provision a laptop, set up payroll, assign a desk, get them a security badge, grant them access to the building. I mean, that is a workflow. It crosses IT, HR, facilities, and security.
And traditionally, that involves emailing 4 different people in 4 different departments and just hoping they all talk to each other.
Exactly. It's the swivel chair problem.
Yeah.
You are swiveling between your email, your HR system, your finance system, and your facilities spreadsheet.
Does it matter?
ServiceNow said, what if we use our engine to manage all of that?
So they became the platform of platforms.
That is the term they use, and for once, it's not just marketing fluff. It actually describes the architecture. They don't necessarily replace the big systems you already have.
Right.
They don't replace Workday for HR records. They don't replace Salesforce for customer records. They don't replace SAP for finance.
They sit on top of them.
They sit on top.
Yeah.
They are the digital glue or the workflow automation layer. Imagine a dashboard, a single pane of glass that pulls data from all those messy, disconnected systems underneath and gives the employee one clean place to get work done.
Which sounds incredibly valuable. It's solving that fragmentation problem that every big company has.
It is valuable, and the economic engine proves it. I mean, we are looking at a company where approximately 97% of their revenue comes from subscriptions. This is a recurring revenue machine.
And once they get in, they don't seem to leave.
Yeah.
The stickiness stats in this report are they're wild. Customer retention is reported at roughly 98 to 99%.
That is effectively full retention. In the enterprise software world, you essentially have a leaky bucket. You're always losing some customers. The companies go bankrupt, they get acquired, they downsize. So hitting 99% retention means almost nobody chooses to leave voluntarily.
And not only are they staying, they are buying more.
Mm-hmm.
The report says net retention is well in excess of 100%. And here is the stat that really jumped out at me. Approximately 80% of their new annual contract value, or ACV, comes from existing customers.
Right. That is the land and expand model in its purest form. They land in the IT department. Then, a year later, they walk down the hall to the head of HR and say, hey, you know how much IT loves us? We can do the same for your onboarding process.
And the contract value doubles.
And suddenly, the contract value doubles. Then they go to customer service. Then to legal.
So, under a normal framework, I'm looking at this and cheering high retention, high expansion, recurring revenue. This is the holy grail of software as a service. So why do we need the skeptical framework here? What is the downside of having such loyal customers?
The skepticism comes from that same statistic. If 80% of your growth is coming from people who are already paying you, you have created what we call a fragility vector.
A fragility vector.
Yeah.
That sounds ominous. Break that down for us.
It means your growth is heavily dependent on the wallet share of a finite group of companies. You aren't hunting on the open plain anymore. You are farming a walled garden. Now, farming is great. It's efficient. It's high margin. But what happens when the soil gets a little dry?
You mean if budgets tighten at those big companies?
Exactly. If the CFO at a Global 2000 company says, we need to cut software spend by 10%, or we are freezing new projects, they might not cancel ServiceNow entirely because that would break their workflows.
Okay, so the retention rate stays high.
Right, but they stop buying new modules. They stop expanding seats.
Ah, I see. So the headline retention number, that 99% might look stable, but the growth engine, the expansion, could fall off a cliff overnight.
Precisely. A model driven by expansion looks incredibly stable right up until the moment it isn't. Growth can decelerate quickly even if clients don't leave, simply because they stop buying more.
And this brings us back to the missing documents.
It does. Without the raw data to see the bookings trends or the remaining performance obligations, the RPO in detail, specifically the current RPO, we can't tell if that slowdown is already happening.
We are seeing the revenue, which is a lagging indicator. It tells us what happened last year.
Exactly.
But we can't see the bookings, which is the leading indicator that tells us what will happen next year.
Correct. And that is a classic blind spot. It's the difference between driving by looking out the windshield versus driving by looking in the rearview mirror. Everything looks fine in the mirror until you hit the wall.
Okay, let's pivot to the shiny object in the room.
Mm-hmm.
It is 2026. You cannot talk about enterprise software without talking about AI. And ServiceNow has been shouting from the rooftops about this.
They have. Since September 2023, with their Vancouver release, they have been aggressively rolling out generative AI solutions.
And on the surface, the numbers look promising. The report says they hit $600 million in AI solution ACV in 2023 alone. They beat their own goal of 500 million.
That is a significant beat. It shows there is real demand for these tools.
And they are targeting $1 billion in AI ACV by 2026. So right now, as we speak, they should be closing in on that $1 billion run rate. They've introduced these Pro Plus SKUs, which is basically fancy talk for we charge you more if you want the AI features.
Right. The strategic argument is that AI is a monetization lever. They aren't scared of AI. They are selling the picks and shovels. They are saying, we will give you the tools to make your workflows smarter, and you will pay a premium for it.
It makes sense. Instead of a human agent resetting your password, the AI does it. Instead of a human HR rep answering how many vacation days do I have, the AI answers it. That saves the customer money, so ServiceNow captures some of that value via a higher price tag.
That is the pitch. And it's a good pitch. But here is where we need to apply the skeptical framework. This is the most dangerous part of the thesis. We need to talk about the seat count paradox.
The seat count paradox. This feels like the elephant in the room for the entire software industry right now.
Yeah.
Walk us through the mechanics of this.
Okay. How does ServiceNow historically make money? What is their unit of value?
They charge per seat, per user.
Right. It's a per user per month model. If you have a call center with 1,000 IT support agents, you pay for 1,000 ServiceNow licenses so those agents can log in and do their work.
Okay, I'm with you.
Now, you implement this fantastic Gen AI from ServiceNow. It summarizes tickets, it drafts responses, it automates the routine stuff. Suddenly, your agents are 50% more efficient.
Which is great for me as the customer. I'm saving time.
It is great for you, but if your agents are 50% more efficient, do you still need 1,000 of them?
No. I might only need 500.
And if you only need 500 agents, you only need 500 ServiceNow seats.
Oof. I see where this is going. So by selling the technology that makes the customer efficient, they are essentially cannibalizing their own revenue base.
That is the risk. It is the deflationary nature of AI. If the value proposition is do more with fewer people, eventually the software vendor selling per person is going to feel the pain.
But wait, they are charging a premium for the AI, right? That Pro Plus SKU. Doesn't that offset the lost seats?
That is the bet. They are betting that the price increase per seat will be higher than the volume decrease in seats.
Ah.
They are betting they can raise prices by 20% while you cut your staff by 10%.
That is a dangerous game. You're fighting gravity.
You are fighting the customer's incentive to cut costs. And remember, there is another cost factor here. AI isn't free to run.
Right, the compute costs.
We call this inference cost. In the old SaaS world, gross margins were beautiful, 80, 90%. Because once you write the code, copying it for the next customer is basically free. Serving a web page costs fractions of a penny.
But running a large language model isn't a web page.
No. Every time that AI generates a summary or writes code, it is burning GPU cycles in a data center somewhere. That costs electricity, that costs hardware, that costs cooling.
So their gross margins could take a hit.
Exactly. So you have a potential squeeze on both ends. Fewer seats being sold because customers are downsizing, and a higher cost to service the remaining seats because of inference costs.
Is there any evidence of this happening yet?
The report says there is no evidence yet of AI eating into software revenue in a major way. But again, our skeptical framework warns us about second-order effects.
Meaning it happens slowly, then all at once.
Exactly. Companies don't fire half their staff the day they install the AI. They let attrition happen. They stop hiring backfill. It's a slow bleed.
A slow bleed of seat counts.
And this brings us back to the missing 10K.
Of course.
It does. Because without the 10K, we can't see the granular seat count trends. We can't see if the net retention is being propped up by aggressive price hikes while the actual usage volume, the number of humans logging in, is dropping.
That is a critical distinction. Are we growing because customers are using more, or just because we raise prices?
If it's just price hikes, that is not sustainable. Eventually, the customer pushes back.
And there's one more risk with the AI narrative, isn't there? Commoditization.
Right. Is the AI actually special?
This is the spell check argument.
Exactly. Think about spell check. 25 years ago, a word processor with a really good spell checker was a premium product. You might pay extra for it.
Sure.
Today, if an app doesn't have spell check, you delete it. It's table stakes. It's expected.
So the risk is that summarize this ticket or draft for reply becomes the new spell check.
Correct. If Salesforce adds a summarize this ticket button, and Microsoft adds one, and Zendesk adds one, are buyers going to pay a 30% premium to ServiceNow for it? Or will it just become a cost of doing business?
So the risk is that they spend millions developing these AI tools, drive up their computing costs, and eventually customers refuse to pay extra for it because everyone has it.
That is the commoditization risk. So while the billion-dollar revenue target sounds impressive, the quality of that revenue, the margin profile, and the durability is under question. We might be trading high-margin software revenue for lower-margin AI utility revenue.
This leads us perfectly into the financials. Because if we are worried about margins and revenue quality, we need to look at the books.
Or what we can see of the books.
Right. So looking at the headline numbers for 2025 and projections for 2026, revenue is projected to hit around $13.2 billion by 2025.
Yeah.
That's up from about $9 billion in 2023. I mean, that is strong growth.
It is, roughly 20% year-over-year growth. For a company of this size, passing $10 billion in revenue growing at 20% is impressive execution. We have to give credit where credit is due. Bill McDermott and his team are sales machines.
They're looking at margins. Operating margins are expanding from about 8.5% in 2023 to projected 13.7% in 2025. That's the operating leverage story we love to hear. As they get bigger, they get more profitable.
On paper, yes. But here is where I have to wave the red flag. The biggest red flag in modern tech investing.
Let me guess. GAAP versus non-GAAP.
You got it. The quality of earnings gap.
Let's explain this for the listeners who might see these terms thrown around on, financial news, but not really grasp the implication.
Okay. GAAP stands for Generally Accepted Accounting Principles. It is the strict legal way you have to report profit to the SEC. It includes all your costs.
And adjusted or non-GAAP?
That is the company saying, well, ignore these expenses over here because we don't think they count. It's like posting a photo on Instagram with a heavy filter versus the raw photo.
Right.
One looks flawless, the other shows the wrinkles.
And usually the biggest wrinkle they filter out is stock-based compensation.
Correct. SBC. Paying their employees in stock options instead of cash.
Why is this such a big deal for ServiceNow specifically?
Look at the gap in the numbers. In the 2025 projection, their GAAP net income, the real legal profit, is projected at $1.7 billion, but their adjusted net income is $3.7 billion.
Whoa. That is a $2 billion difference.
It is a massive gap. It's more than double. They are asking us to ignore $2 billion worth of expenses.
And most of that is stock they are giving to employees.
Almost certainly. And here is the problem. Stock-based compensation is a real cost. It's not monopoly money. If you issue more stock to pay employees, you are diluting the existing shareholders.
It's like slicing a pizza. If I own a slice and you suddenly cut the pizza into 20 more slices to give to the staff, my slice gets smaller.
Exactly. Your ownership stake shrinks. So when they say we are trading at a cheap price-to-earnings multiple, they are usually using the adjusted earnings number, the $3.7 billion.
But if you use the GAAP number, the $1.7 billion, the stock looks twice as expensive.
Precisely. And this brings us back to the missing documents again. Usually, to check if this dilution is hurting us, we would look at the cash flow statement in the 10K.
We would look for two things. One, how much cash are they actually generating? And two, how much are they spending on share buybacks?
Because if they are issuing a ton of stock to employees, they usually try to mask it by buying back stock from the market.
The report mentions they started share buybacks in 2023.
They did. But without the filings, we cannot verify the efficiency of those buybacks. We can't see if those buybacks are actually reducing the share count or if they are just treading water against the flood of stock options being granted.
So they might be spending billions of shareholder cash just to keep the share count flat.
That is a very common scenario in tech. It's called the SBC treadmill. You run faster and faster, spending all your cash flow just to stay in the same place.
Wow.
And because we are missing the raw data, we have to assume the worst. We have to assume that high adjusted margin is a trap.
It's the skeptical framework in action.
Yeah.
We can't give them credit for profitability we can't verify.
And there is another weirdness in the cash flow numbers that caught my eye. The free cash flow margins are volatile. They were around 23% in 2023, but the projections show them dipping to 14 or 15% in 24 and 25.
That's a big drop. Why the volatility?
It could be tax payments, it could be working capital shifts, but my gut tells me it's the AI infrastructure build-out.
Buying the chips.
Buying the GPUs. Building the data centers, that is capital intensive. If they are pivoting to AI, their capital expenditures, CapEx, are going to go up. That eats into free cash flow.
So we have a situation where revenue is growing, But the actual cash left over for shareholders might be shrinking or getting more volatile.
Profitless prosperity, or at least expensive prosperity. You are getting bigger, but it costs you more to stay big.
Let's move to the people running the ship. Management. Who is at the helm of this machine?
We have Bill McDermott as CEO. He took over in October 2019.
A big name. He's a celebrity CEO in the enterprise world.
Huge. He was the CEO of SAP for years. He wrote a memoir called Winner's Dream. He is known as a sales machine. He is incredible at the narrative. He is the one pushing this platform of platforms story.
And the CFO is Gina Vistantuono.
Right. She joined around 2020. She gets a lot of credit for improving disclosures, ironically, considering our lack of documents today, and for driving that margin expansion story.
So, strong leadership, experienced. The analyst report rates them as fair to exemplary. But there is a shift happening in 2026 that has you worried.
Yes, the M&A strategy. Mergers and acquisitions.
Historically, ServiceNow has been pretty disciplined. They buy small companies. Tuck-ins.
Tuck-ins.
Yeah, you buy a small startup for $50 million to get a cool piece of technology or a few smart engineers. You integrate it easily. It doesn't disrupt the business. It's like adding a new feature.
But the report says that in 2026, they are expecting to close 2 acquisitions totaling approximately $9 billion.
$9 billion. That is not a tuck-in. That is a transformative deal. That is a meal that can give you indigestion.
Why is this a red flag? I mean, if they have the money or the stock, why not grow?
2 reasons. First, why now? Why spend $9 billion in 2026?
The skeptical take would be, organic growth is slowing. Exactly. When you can't grow 20% by selling your own product anymore, you go out and buy someone else's revenue to stack on top. It paints over the cracks. You can show Wall Street, look, our revenue grew, but it's purchased growth, not organic growth.
So it's a financial engineering. You're buying growth to keep the chart moving up.
Precisely. And the second reason is integration risk. Bringing in a $9 billion company is messy. Different cultures, different technology stacks, different sales compensation plans.
And it creates goodwill on the balance sheet.
Yes. Goodwill is basically the premium you paid over the actual value of the assets. If you buy a company for $5 billion, but they only have $500 million in real assets, you have $4.5 billion of goodwill. If that acquisition fails to perform, you have to write that goodwill down.
Which means massive losses later on.
It also muddies the water for us analysts. Once you mash 2 big companies together, it becomes very hard to see the underlying health of the core business. Are they churning customers? Is the core ITSM business shrinking? It gets hidden in the integration noise.
So McDermott is a sales machine, but is he pivoting to an empire-building phase because the core engine is running out of steam?
That is the fear. The report specifically notes that investors generally dislike it when high-multiple software companies start doing big M&A. It signals a shift from growth to maturity, and maturity usually means a lower stock price multiple.
And without the proxy statement, the DEF 14A, we can't see how management is incentivized.
That is the missing piece of the puzzle. How is Bill McDermott paid? Is his bonus based on total revenue? If so, he has a huge incentive to spend that $9 billion to pump up the revenue number, even if it's a bad deal for shareholders.
But if his bonus was based on return on invested capital, he would be much more careful.
Exactly. And we don't know. We are flying blind on incentives.
Let's talk about the defense. The moat. Despite all these risks, the AI cannibalization, the accounting gaps, the M&A ServiceNow is still a fortress. What keeps the customers from leaving?
The primary moat is switching costs. We touched on this, but it bears repeating. Once you implement ServiceNow, it is agonizing to rip it out.
It takes months, sometimes years, right?
The report mentions that in complex cases, deployments can exceed a year. You have to retrain your entire staff. You have to migrate terabytes of data. You have to re-engineer workflows that touch every department.
It creates operational risk.
Operational risk is corporate speak for, if I mess this up, the company stops working and I get fired.
CIOs are risk averse. They want to keep your jobs.
Exactly. Even if ServiceNow raises prices, even if the service degrades a bit, the CIO is terrified of ripping it out. That is a powerful moat. It gives them pricing power to a point.
And they are diversifying. They aren't just in IT anymore. They are in HR, customer service, creator workflows, so they are digging their claws in deeper.
Right. If they were just the IT help desk, you could replace them. But if they are running your HR, onboarding, AD, your customer service, and your security ops, you are married to them. You are locked in.
So the defense is strong. But there is a new threat emerging, the bundling war.
This is the scary part. As ServiceNow expands out of IT, they are stepping into the ring with the heavyweights. They aren't fighting small startups anymore. They are fighting Salesforce. They are fighting Microsoft. They are fighting Atlassian.
And the overlay vulnerability comes into play here.
Yes. Remember, we said ServiceNow sits on top of other systems like Salesforce and Workday.
Right, the digital glue.
Well, that's a nice place to be until the guy underneath you stands up. What happens if Salesforce builds a better native workflow engine? What happens if Workday says, hey, you don't need ServiceNow for onboarding anymore, we built it directly into Workday?
And since customers are already paying for Salesforce and Workday,
The CFO looks at the bill and says, why are we paying ServiceNow a premium to do something that Salesforce is now throwing in for free?
the bundle. Microsoft is the king of this. Oh, you want chat? It's free in Teams. You want security? It's free in Azure.
Exactly. Microsoft killed Slack, mostly by bundling Teams. Now they are coming for the workflow layer. ServiceNow has to prove that its glue is so much better than the native features that it is worth paying millions of dollars extra for.
And that gets harder as the ecosystem politics heat up.
It does. Partners can turn into frenemies. Salesforce used to be a partner. Now they're a direct competitor in the customer service space. If Salesforce decides to make it hard for ServiceNow to integrate, if they change their APIs, if they throttle data access, the glue stops sticking.
So the moat protects renewals.
Mm-hmm.
People stay because it's hard to leave, but it doesn't guarantee pricing power.
That is the nuance. You can have a high retention rate but lose your ability to raise prices. You become a utility. You are necessary, like the electric company, but you have no leverage. And tech stocks do not trade at 10x revenue if they are just utilities.
Okay, we've covered a lot of ground. We have looked at the business model, the AI pivot, the confusing financials, the management shift, and the competitive landscape. Let's try to bring this all together.
Let's synthesize. We need a verdict.
Point one, operationally, this looks strong. Retention is high. Margins are expanding. They are hitting their AI targets. $1 billion is in sight.
Agreed. If we just look at the surface metrics, this is a top-tier software company, a blue chip in the making. It has executed brilliantly for a decade.
Point two, valuation. Trading at 109. Fair value estimate is 200. It looks cheap.
It looks like a bargain if the story holds up, if the accounting is clean.
But point three, the skeptical framework.
The framework says we cannot validate the thesis. The failure to provide the 10K and 10Q is not just a paperwork issue. It prevents us from answering the most critical questions.
We can't verify if adjusted earnings are just masking massive dilution from stock-based compensation.
We can't verify if that impressive net retention is being propped up by aggressive price hikes, while seat counts silently erode due to AI efficiency.
And we can't verify the true impact of this new $9 billion M&A spree on their returns on capital. Are they buying good assets or just buying revenue to hide a slowdown?
Exactly. We are being asked to trust the narrative without seeing the receipts. And in this market environment on Friday the 13th, trust is not enough.
So what is the verdict? Is it a good business?
Likely, yes. It has the traits of a great business. It is sticky, it is mission critical, it has a clear purpose.
Is it an investment today under this framework?
No,
Yeah.
not under the skeptical buy-side framework. The burden of proof is on the company to prove it is investable. And without the primary documents, that burden is not met. We have to stay on the sidelines.
It's a harsh ruling.
Investing is harsh. The first rule of the buy-side is don't lose money. You can lose money on great companies if you buy them at the wrong time or based on the wrong assumptions.
I like the closing thought from our notes here. In investing, no evidence of failure is not the same as proof of success.
That is the mantra. Just because we don't see them crashing doesn't mean they aren't slowly leaking air. Until you see the raw data, a great story is just a story.
And especially with AI changing the fundamental physics of seat-based software. You want to be very, very sure about those seat counts.
Absolutely. The seat count paradox is going to be the defining story of SaaS for the next 5 years. ServiceNow is right in the eye of that storm. They might navigate it perfectly, but we need to see the navigation charts before we get on board.
Well, that wraps up this edition of the AI Investment Memo. A fascinating, slightly terrifying look at a giant of the industry, ServiceNow.
A giant that requires a closer look than we were able to give it today.
A reminder to all our listeners, this deep dive was based on a specific snapshot in time, February 2026, and a specific set of constrained sources. The market moves fast.
And always check the 10K.
Always check the 10K. Thanks for listening, everyone. We'll see you on the next deep dive.
Stay skeptical.